Two retirees can have, dang it, cut. All right, we'll go again. Two retirees can have the exact same portfolio, earn the exact same average return, and end up with dramatically different outcomes. Why? Because successful retirement investing isn't about how much you earn, it's about when you earn it, how much you're withdrawing, and whether your investment strategy is designed for retirement income. Today, featured advisor Ellie Robinson joins me to explain. Welcome to Paladin Financial Talk, and welcome, featured advisor Ellie Robinson.
Hi, Nikki. I'm so happy to be here.
All right, I'm looking forward to hearing your expertise today on this. So, Ellie, you just got back from a fantastic trip. You got to relax a little bit, but then took in some good information going on in the industry. You were with some of our great distribution partners, and they were hosting this, and you got to talk with other financial advisors out there. You got to tell me, give me something here that what was the theme? What's going on that our listeners should know about in our industry?
Yeah, I mean, one of the biggest things that I've been noticing in the last couple years is just the reoccurring topic of AI and technology. And truly our top distribution partner is really focused on helping our back office with the improvement of technology to really alleviate those administrative tasks that all of us advisors are doing and help lessen that burden so we can get in front of more clients and give our clients more of our time, essentially.
Absolutely. And that's the part that I know I feel myself feeling overwhelmed is when I'm spending too much time on mundane tasks, when all I really want to be doing is touching base, making sure that we are being the very best that we can be for everybody that we're serving. And so I would agree, that's no surprise that AI and technology is a theme that we're hearing all over the place. And so fantastic partners that we have behind the scenes helping us make sure that we can bring strong technology to our office to help our administrative and operations team, and then ultimately benefit our clients. All right. Well, Ellie, today, let's just talk a little bit about your background, because I think that you bring a really fun perspective to planning. And I want to make sure you have a chance to brag on yourself just a little bit.
Okay.
But you started with us. Oh my gosh, today is your anniversary.
4-year work anniversary.
We didn't even talk about this, but as I'm getting ready to introduce you. So 4 years today. Congratulations.
Thank you.
I know you didn't start with us in the financial services industry, and you had some years before you came on board, but you did start with Mr. Jeff Foley and working alongside of him to see how he moves through the financial planning experience and the model that he has created. And now you work directly with clients on your own and helping them with their financial journey and preparing financial plans and supporting their goals. You have all the licensures of the 6 and the 63 and the 65. You're studying for your CFP, which is
what a beast.
major hurdle. Exactly. But this is the part that I wanted to talk about. You were a graphic designer in your previous life. And so how does that play into the way that you look at financial planning and supporting your clients?
Oh, yeah. There's a part of me that I will always think of myself as a designer. So back in the day when I was doing all the digital designing and UI, UX designing and graphic designing, a little bit of interior here and there too, a designer at the end of the day, they are creating solutions that are functional and clear and visually effective.
Yeah.
And so a lot of times as a designer, you're asking yourself, what problem are we trying to solve? Who is using this? And what is the best way to create something that works well for them? Well, now instead of working with colors, I'm just working with numbers.
Yeah,
right?
Absolutely. I find that each advisor brings something that's a little bit different to the table and when they're working with clients, and they oftentimes attract others that are similar to them. And so much of that is you are who you are, and you're going to take it wherever you go, whatever you're working on. And so that whole concept of designing from a visual perspective and then applying it to the financial side makes complete sense. And so I love the way that you approach this and kind of the feel that you have that goes along with that. Well, today you are our third guest in our series as it relates to investment strategies and withdrawal strategies. And that feels kind of heavy and like, my goodness, why would we get into the nuts and bolts like this with our listeners? But I think that there are some really good key strategies that guide investment and retirement planning. And whether you're building wealth during your working years or you're creating income that's going to last your entire retirement, it's good to know what is going on behind the scenes, at least at a high level. And we'll break down those investment and withdrawal philosophies. We started with Jeff, and then we had Jack from our advisor team. So you're going to talk a little bit more about what Paladin does, but keeping it also fairly broad to compare about what's going on alongside of this and what are some of the options in the industry. And then the whole goal is just helping understand it's not just about the decisions that are made, but why all of this matters. So I'm looking forward to this. So let's go ahead and get into this. And I'm going to do this in a question and answer format, if that works for you.
Okay.
And so we often talk about investing as just one piece of a larger financial plan. So how would you describe an investment philosophy or strategy that guides our clients?
I love this question, Nikki, because philosophy and strategy are technically two different things, right? So there are many investment philosophies that professionals use and combine. For example, the modern portfolio theory is one of the biggest ones out there that emphasizes the philosophy of reducing risk by diversifying, essentially, rather than just having individual holdings. So that's a big one. It's very common. There's the efficient market hypothesis, too. That's a very textbook one for us in our industry, and that believes that it's nearly impossible to outperform the market, but the embedded costs and taxes matter greatly in your overall return. There's also behavioral finance approaches. There's tactical asset allocations that will move your money depending on what the market is doing. Buying and holding investing, where you just stay put and you don't make any changes. And there's more than that. So I mention all of these because the philosophies are technically the undertone to the investment planning that we're doing, and it can be more or less tailored to the individual client that is coming through our door. At Paladin, though, what we're focusing on is the retirement income strategy.
Okay.
So that is what we really niche in and focus on. This combines a lot of the investment philosophies that I've already mentioned, but it will come up in a lot of our client meetings where we mentioned a bucket strategy, which will specifically focus on, market volatility and sustainable withdrawals in retirement.
Okay, Ellie, you did such a good job of taking a moment to describe philosophy versus strategy. So, two things that I heard you say up there at the end there was we are addressing with our strategy, the bucket strategy specifically at Paladin, market volatility and then sustainable withdrawals. Because yes, we do focus on retirement planning, but you and I've had this conversation. We did a recent webinar together. Retirement planning, you think, oh gosh, that's not until I get to be 56, 57, as I'm getting closer to retirement. Reality is it starts the moment that you put money in a 401k or anything that you're planning for retirement. And so there's different phases of retirement planning as you move through different parts of your working career. Okay, so market volatility and sustainable withdrawal. So let's go into this bucket strategy that you mentioned as one of the approaches that we use most frequently. If you don't mind, just walk our listeners through what this is, how it works, why it's valuable, and just give us an overview.
Yeah. So rather than viewing your investment portfolio as one large pool of money, the bucket strategy really divides your assets into separate buckets based on when you are going to use these monies, essentially. So we carve out a portion of their money essentially into a short-term bucket. And so that's their short-term spending bucket. These funds will likely be used within the next couple years is what they're earmarked for. And oftentimes we want this bucket to be liquid and relatively conservative with minimal risk, right? We don't want a lot of market volatility with money that you might be using 6 months from now. So this will help fund any of those current spending needs. And it will also help avoid selling stocks when there is a market downturn.
Would you also say people may be familiar with the term like emergency savings? Would you put that in this bucket as well?
Absolutely. Yes. Emergency savings hits the nail on the head with liquidity and minimal risk.
Okay. Perfect. Okay, I interrupted you there.
That's okay.
Next phase is this midterm.
Yeah, so that midterm bucket or the intermediate term bucket, this is, funds that might be used in 3 to 7-ish years from now. Every advisor might think of it a little bit differently. They might say 8 years, 10 years, give or take. It's in the intermediate term time horizon. Now, this pool may have exposure to conservative balanced funds specifically. So the intention of this is to honestly just generate modest growth and just keep up with inflation. As a lot of us know lately, inflation has been a little bit higher than normal. We want to make sure that your money is working for itself and keeping up with that and not just sitting in cash and losing your dollar against inflation over time. So the intention with that bucket is you'll help refill your short-term bucket over time as you start spending your short-term bucket.
Okay. All right. So now we've got short, medium, and now
got your
long term. Okay.
Absolutely. Yeah. So this is usually coined your growth bucket, right? Those funds will be used 8+ years out. I specifically like using that 8+ year out time horizon versus some advisors say 10 years is because the 2008 crisis was the second largest stock market crash in U.S. history, right behind the Great Depression. It took about 6 or 7-ish years for the market to fully rebound from that massive decline. And so if we know that if we enter into a massive recession again, it might take up to that amount of time for your money to rebound. Now, statistically, when you do enter into a bear market or into a recession, the average time it takes for the market to rebound is 18 months. So keep that in mind too. Normally, they're a lot shorter than that time horizon that I just mentioned. But with that long-term bucket, it is specifically designed to outperform or outpace inflation. We're trying to get some growth. We're trying to get some returns out of it. And we're trying to support, those spending years that you will have 30 years from now. And as you enter into retirement now, you're still hopefully going to be alive in 30 years from now. We're trying to support that lifestyle then.
Ellie, one of the things that you've mentioned here, and I also want to point out, you gave time frames that went along with this. I do think that you are going to hear, if you're hearing the bucket strategy, it's also known as the time segmentation. We use bucket in our office. Those time frames can vary, and it really doesn't matter in the scheme of things. It's just knowing what's being applied to your money, which you've described. Okay, I'm going to put you on the spot here if you're okay with this. One of the things that you do when you're working with your clients is you draw on the whiteboard or you have it on the screen and you're giving them a grid. Will you walk through just kind of a visual grid of how this all applies there's a tax approach that goes along with this as well. Will you just briefly go through that concept?
Goodness. Okay. We're both visual creatures,
yes,
so
know.
this is hard.
This
is hard talking through it without actually drawing it out. Okay. So if you draw out an arrow, from the left-hand side of the board through the right-hand side, and that is your time horizon. The left-hand side of this arrow, that's your short term. And then, you go along the line to the right-hand side and you're going into your long term. So that's your time horizon there. When I'm drawing this out, that's where I'm breaking down the buckets and the years to clientele that I'm sitting with in the conference room. I make sure that they understand the time horizon. And then I introduce the taxation that we're thinking about too. So on the left-hand side, we have taxable that we're thinking about. We're thinking about tax deferred and then tax free. Okay. So I write those words down on the left-hand side of this essential grid that I'm starting to draw out. When you when you draw everything out and you draw the lines in between the short term and the midterm and between all of the tax accounts that we're talking through, there's essentially 9 different buckets that you're looking at. And so a lot of times how I'm approaching that conversation with clients is not every bucket might be filled right away, but the whole premise is we want to be well diversified. So when we do get into retirement, we have the luxury of pulling from the correct bucket at the right time, essentially.
Absolutely. And that's really the point that I was hoping that you would get to is when you oftentimes are first working with somebody, you'll find that maybe their short-term taxable bucket is heavy and maybe a long-term tax-free or tax-deferred bucket. And there is not a lot of other diversification. And so that really is the value of making sure that you can see that and recognize how there may be an imbalance in your current situation.
Oh, yeah. Yeah.
So that you hit it right on the head with where I was hoping that you would go with that. So a bucket strategy clearly is one way for us to approach that. There's certainly other ones. I know Jeff was on our show 2 times ago, and he went through some broad perspectives as well. But there are other things that are important for investors to understand when they're building long-term wealth and retirement income. Taxes is one of them.
Mhm.
Just, is there anything else that you want to add on to this concept of the bucket strategy, or anything to point out that you think is relevant in this conversation?
Yeah. I mean, it really takes us to our fundamental education of with our clients is all of our clients have a Paladin plan. And so we're educating them on their Paladin plan and all of the areas that we are focusing on within their Paladin plan. Investments and taxes have already kind of popped up in this conversation, but then their health and estate are also the other two pillars that we want to focus on when we are talking about building wealth over time and then making sure that we sustain it during the retirement income phase too.
Yeah.
It's going to look different at different phases of your life. So that's why, like you kind of mentioned, it starts at the very beginning. It's not just when you're trying to retire, when we're focusing on all of these four things. So does that help answer?
Yeah,
Okay.
absolutely. Absolutely. So again, these terms are so heavy on some of this, and you're like, goodness, do people really want to know about all of this? But, you know, asset location and where you're going to withdraw from. You talked about that in the bucket strategy and how that ends up being in this grid like approach. As for retirement income, there is risk as it relates to market decline. There's things like inflation and longevity. And again, Jeff had done some of those conversations, but there's two things that I want to make sure that we cover before we kind of end this conversation today. And I think it's really important. And we've started the conversation a little bit, but the emotional side.
Oh, yeah.
Emotions become a really big piece of this, even if you have a lot of technical working behind the scenes, which we've covered, as well as this concept of sequence of return, which oftentimes can be a very large risk. One, from a behavioral perspective, but two, if you just do not have yourself structured adequately. So we can take this in either order. Let's just talk about the emotional side first, because that impacts everybody. That's real life. And so no matter what, if you have a philosophy or a strategy working behind the scenes, the reality is real life is happening and you have emotions. So walk us through how having a strategy can help balance out that emotional side of investing, and even having an advisor to help be a quarterback in that as well, if you want to touch on that.
I mean, there are so many studies out there that suggest that investor behavior can have larger impact on outcomes rather than just the investments that they're holding, right? And so a lot of common mistakes that are out there are there's people who are chasing recent winners, or the news headlines more recent have been the IPO of SpaceX.
Yes, exactly.
Where Jeff and I both had a lot of clients reach out asking, like, how can I get my hands on this SpaceX IPO? And we say, are you sure you're conservative investors? Are you sure you want to have exposure to this huge thing that's in the market? Taking excessive risk during bull markets is also a huge mistake that we see, because I think a lot of times people have the rose-colored glasses on. We're hitting a bull run, the market's doing so well, they want to increase their risk tolerance. Okay, but how are you going to feel if there's a drawback?
Yeah.
So that is a huge thing that people are not very mindful of. Holding too much cash after periods of uncertainty too is huge. So that is more for the people who are scared to enter into the market. And then I think the most obvious one is selling specifically when the market declines. So when you have a plan and you stick to it, you're just going to have a higher chance of success in the long run. So sometimes, and this is an example that I see more frequently. I don't know about you and Jeff as advisors, but sometimes I see clientele who come in and they're naturally just conservative. They're scared of investing in the market. They have a nice nest egg, but it's mostly in cash reserves and however they obtained it, whether it was saving, inheritance, whatnot. And they're hesitant to put their money into that long-term bucket that we just talked through. But over time, as we do more coaching and I give them more education and I really drill in the investment philosophy and strategy that we are teaching here at Paladin, they will eventually become a little bit more comfortable to allow some of their investments be in that growth-oriented bucket. And the whole premise of it is we need to make sure that we outperform inflation over time.
Yeah.
Like that is that is the biggest reason usually. So
I don't know if you run into this, but when we are, meeting with prospective clients, and oftentimes you'll ask a series of questions to get a feel for what their risk tolerance is. And a common response is, well, are we talking about all of my money? Or are we talking about a portion of my money? Because there is this need for to know it's going to be there, but they also have tendencies to want to make sure that they take advantage of, being a little bit riskier and the market. And so I think that going back to that bucket strategy, it allows us to get a feel for what is, kind of what are their tendencies. And it's not an all or nothing. And, it allows us to have some of those conversations that I feel like that's a recurring one that I get quite a bit.
And there's a lot of coaching of like, we're professionals here. Like, there's a lot of control over this long-term bucket. I'm not just throwing your money into speculative investments. Like, we're not a hedge fund. Like, it's going to be okay. There might be some volatility, but that's okay. It's earmarked for 10 plus years down the road. So there's a lot of coaching.
You gave some really good tendencies there with the bullet points that you made and the points you made. I think you even on top of that, every day comes into play as well. That one, you have your own set of emotions based off of how you feel on any given day. There's family that gets involved. There's kids' demands on, sports and things that you want them. We spent a whole series on the fact that families, they're expensive and there's a lot that goes into that. So, the tendencies you mentioned is just one layer of the behavior. It's then the everyday life that comes on top of that as well. Okay, so Ellie, we have addressed how having a strategy allows you to come back to something and to potentially stay on track or agree to stick with something that made sense when there was no outside pressures happening. But let's talk about this concept of sequence of return risk. Can you explain what that risk is and why is it so important specifically for retirees to understand?
Yeah. And so this goes hand in hand with the bucket strategy, but the sequence of returns risk is a term that really explains the danger that you are assuming if you are taking out your money when there's a down market.
Yeah.
I'm trying to simplify this as much as possible because I think there's a lot to it. But so the danger that poor market returns early in retirement combined with the ongoing withdrawals can significantly reduce your overall assets over time, essentially, is what it is. So even if the long-term average returns are ultimately favorable, you can still run out of money faster if you pull it out at the wrong time.
There you go. Okay. Because here we are again being visual in nature. Can you give anything that can kind of bring this to life? So I understand it because I've seen the visual behind it. I'm exposed to this conversation. Anything else that you would add so that somebody can get a better perspective on this?
Yeah. So let's break it down to two different investors here and the timing of returns of when they're taking out withdrawals of their money, I guess. So investor one, they might be entering into retirement and they are experiencing a 20% market decline in that first year. And they continue to make withdrawals throughout that downturn. They will have fewer assets over the long run as opposed to investor B, who is retiring and they are taking money from a strong market. So I learned this from Jeff. He likes to say we take winnings off the table.
Yeah.
So I say that a lot too, is we like to take winnings off the table, which will allow the remaining money to continue to grow, right? There's still shares there for it to grow. Whereas if you're selling your shares in a down market, there's less for it to recover over time. So with the investor B strategy of taking winnings off the table, that will allow a larger cushion to continue to grow over the years.
So two investors earn the same average return over time, but they experience dramatically different outcomes because one investor is being forced, because they're forced to live off this bucket of money that they have built over all the years. They're now at that withdrawal phase. When the market is down, they're taking principal out when it's down, where in the other case, if you kind of reverse that, if somebody happens to retire when the market is going well, but they have a later point in their life where they're taking out more withdrawals, but they have more money basically growing in the early phase. So you can't deplete early and then expect to have the same outcome as when you deplete later would be. Okay. So very important as it relates to knowing that you have a pool of money or a bucket of money, and why it's important to have this structured in a way that is going to last for whatever that duration of your retirement is, whether we are planning for 10 years or 30 years or potentially beyond that. You have to make sure that there is a strategy behind that that will withstand the test of time and all the risk that might be coming, as well as all of the behavior that might go along with that.
Oh, yeah.
Okay, Ellie. So anything else that I feel like we tried to make that as light as possible on a very heavy topic. So hopefully we did not lose our listeners as we went through this. How about takeaways? You do a fantastic job of listening to what's going on in the industry. You are in growth mode yourself. Just kind of tell us, is there anything that you would recommend to our listeners that if they really want to pick up on more of this, is pretty technical, but they want more of this type of information, where would you send them?
Yeah. You know what? One of my most favorite podcasts out there is a wealth management firm out in New York.
Okay.
And they are talking to advisors, but I do think like if you want to get nitty gritty as a consumer outside of finance, like this is a good podcast to listen to. It's called Animal Spirits.
Okay.
They're two CFAs. They talk very much economics and just stock market movement. One of my favorite podcasts. And I went to an event years ago in Huntington Beach, and I were able to meet the team members of Ritholtz Wealth Management, and they're such cool guys. So that is going to be my more technical podcast to recommend for listeners out there that want to get a little bit more financially savvy. But for the consumers out there that might want a lighter resource and maybe not so heavy in the finance vocabulary, I do think Charles Schwab and Morningstar has great resources. They have fantastic articles that break down the sequence of returns risk, and they break down the bucket strategy that is easy and manageable for people to read, and they don't need to know all of the financial terms out there and consume it easily.
Yeah.
So,
one of the things that we are making available every time we do a podcast or a series, we like to have a takeaway that our listeners can download. And so we have a chart. Again, back to being visual. Like 60% of the population is visual. So I don't think it's so odd that I bring things back to visual all that often. But it's the sequence of return chart. So you can actually see what happens, and it has a little bit of a description that goes along with it. We're making that available to our listeners so that they can have that as available as a download. And again, if you feel like this is something that you're enjoying, Ellie had mentioned Charles Schwab and Morningstar, and we'll make both of those available on our podcast page so that people can go out and download the takeaway, as well as link out to potential other conversations as it relates to what we've talked about. Anything else you want to add before we wrap up?
I don't have anything else besides thank you, Nikki, for having me here today on my work anniversary. It's been so much fun.
I love it. What a good way to feature and capture everything that you know and share that with those that are listening today. Well, as a listener, if you're sitting there thinking, gosh, this sounds like me, or I just want a second opinion on where you stand, our team at Paladin Financial is willing to offer a 15-minute, no obligation conversation just to help you get some clarity. And so you can book one of those appointments all on your own by visiting our website at paladinfinancial.com, or our show website is paladinfinancialtalk.com. Either one of them has a booking tool in the top right corner. Find the advisor, whether it's Ellie or myself or one of our team members that you would like to talk to. Book that 15-minute conversation, or you can always pick up the phone and call us at 651-842-8406. We love to post on social media. I feel like we have even upped our game in that area recently as well. So YouTube, Facebook, Instagram, Instagram, LinkedIn. We are in all of the spots there. So again, take advantage of that download of the sequence of return charts, link out to some of the things that Ellie had talked about today. And thank you again for listening. We'll see you on the next episode. And Ellie, happy work anniversary, and thanks for joining us.
Thanks, Nikki.